As I mentioned, risk appetite is seen in today's environment as the key to overall success of a well thought out and documented customer risk management program. Let's open up our discussion today by asking our first question. So to the panel, in your experiences, what are the key challenges that institutions face in defining their risk appetite?
We're all going to look down my way. We warned you that just asking open questions would be tough. I mean, key challenges in setting this up, I think, let's step back for just a moment. I think key challenge is the fact that 3 years ago, there wasn't a clear effort to define risk appetite. Sure, there were risk assessments, particularly as it relates to AML and other financial crimes, but actually have that articulated statement having to do, what is my risk appetite? How do I view risk? How do I view things that are going to impact my reputation? Have that formally articulated? I say that's more of a recent kind of evolving practice now. And so another word for it is risk appetite. You know, some firms call it risk tolerance. How much risk am I willing to take? Maybe it's for a certain class of client, a certain product, you know, certain business, certain activities in certain geographies. So I think that there's been a regulatory expectation to be moving towards having more of that formally articulated statement of risk tolerance or risk appetite. And with that, there's not a lot of clear guidance out there on doing this. And I'm not saying that should come from regulators. There's just not a lot of guidance in terms of how to think through what that will read like. So I know we're going to talk later about some of the real challenges about the implementation, the specificity of measures, the organizational construct, but I'd say challenging because it's new. Once you write it, you're accountable for it, right? You have an articulated risk appetite, you better be complying with it. And I think that there's not really a clear precedent that all can follow.
So I would agree with that. First of all, I should say at the outset that all my comments that I make here today should be fully attributed to Rob Curry at U.S. Bank, if you don't like him. So I love the concept of a risk appetite. Theoretically is exactly what we need to do. I think we've all been doing it in one form or another for many years. We just haven't necessarily reflected that. But the key challenge in my view, in addition to what Steve said, is how do you take something that really will have to be necessarily at a very high level and make it apply to a lower level? Because it's awesome to say I have a risk appetite. Okay, my risk appetite is I like some risk that's reasonable and controllable, but not too much. Terrific. What advice then do I give to the business that wants to prospect new business in sub-Saharan Africa? How do those two relate? And so I think as we tease this out a little bit more, I'm going to suggest to you that one of the best approaches is you must have what Steve talked about, a high-level risk appetite, a risk tolerance statement, who you are, what you do, that's sort of ingrained in your brain. Then, to make it more applicable, you've got to drop it down, and you've got to be very specific so it's actionable, and that's, I think, the challenges we have right now.
Just a couple points. Definitely that's the challenge as far as making it, is operationalizing your risk appetite. And I think you have to look at it in a few different ways, right? You look at it as an enterprise view side of the house. You also have to look at it at a business line level segment side of the house. And then you have to look at it more granular level. And that is, of course, you're doing your risk assessments, but what I mentioned here is you're also going to go through the due diligence side and say, to William's point, what initiatives are you going to accept? Which ones are you not going to? Also, what are the tiers that also, at the most granular level, form your policy? And that is, what's your prohibited? Do you have prohibited categories? Do you have restricted categories? Do you have different levels of high-risk categories that feed into that? And then how do you balance it not only with the customer side of the house, but you're also balancing it with, again, to the FFIEC manual about the products and geographies too, but what's your regulatory risk appetite? What's your regulatory risk appetite from, the audit side of the house, from the federal regulatory side of the house? How are you interweaving that into your risk appetite too? And I'll pause there, but I just want to mention this.
I'd like to thank you all for leaving me so much to talk about. I would just say that, to reiterate the same, I mean, beyond that, it's also the multidiscipline approach to this. It's not just about the compliance risk. There are other risks to take into account, and how do you get all of those into one common goal? And once you get it into goal, it's easy for us to talk about it theoretically, but taking ownership appears to dissolve in the next step. We can say, we don't want this until the first person says, but I really do want this. So making sure that as we're doing a risk appetite, everybody realizes we'll be responsible for this later.
I think on the collaboration is for those firms that have moved forward with establishing some kind of risk appetite and then set up the structure, the organizational construct. It won't naturally happen, right? You don't have relationship managers sitting around hoping to figure out how they can manage this risk, right? Their job is out there for trying to grow the business. But with each of these risk disciplines and functions, I'm really hoping for a microphone someday here. With each of these models.
I think it's working now. I think it is working now.
God,
Sorry.
why didn't you tell me that? She's clearly not paid to be a moderator. Anyway, so when we talk about the organizational construct, right, where I've seen it put together is there's a mix that includes operational individuals, relationship managers, say the CEO of the business, and they're getting into discussions once they have the qualitative and quantitative information to think about it. Do I retain? Do I exit? Is it a product I want to be in? And so I think it's getting the right people around the table, and usually there's like a compliance leadership in that mix as well.
Specific to your point, that's exactly what we've done. Is you got op risk, you've got credit market risk compliance around the table, and in our case it was because the board wanted a better perspective and picture of it in connection with it, and nothing heightens the senses like an upcoming board meeting, and that forces everybody to the table to lay out what you have, and that, then you discover data issues, all kinds of fun stuff, but that to me was where we got the most traction, and you sat back and you literally asked the question, well, could I measure it this way too? Is there a way that I can adopt that approach, yes or no, and if not, are there ways I can get at it, slightly differently perhaps?
So I would just add that I would break it up into how you're going to take it on going forward and what you're going to do about what you've already done in the past, and distinguish between them. Because the going forward, as soon as you start putting yourself into the actual formal mechanisms, you start stemming the problem. So for me, that's really, for me in particular, and I don't know how it will work for everyone, it's really working through your risk committees. Your product and service committee in particular can be very helpful in inserting it into the mechanism that these risks are going to be formally reviewed. There's going to be some metric to them prior to the adoption of a new product and service. Usually in the product and service committee, you'll have some sort of follow-up that you can see how it actually implemented into the future. And then I would just say, going into the past is always the problem because people have their golden children of, well, I really don't want you to touch this, but it's not quite in our risk appetite. And I think we'll cover that a little bit further, but I think that's really about stating a formal methodology and a way you're going to review it so that people aren't surprised that you're going to start talking about some of the favored clients, customers, and that there are mechanisms to reduce their risk to keep them in the population, or if the business line truly can't prove that we can mitigate the risk, where are we going to go with this, not as a wholesale population necessarily, but individuals.
We talk about defining risk, the risk appetite, the risk tolerance. Let's also talk, though, about the importance of risk ranking a little bit here, too. So once we've defined that organization and who we want from a customer-based perspective, then we've really got to drill into it. So first question for the panel for me here is, once you've set that risk appetite, how do you work towards defining the right criteria at a corporate, a business line, and even a product level to ensure that that customer risk ranking is the right risk ranking for your institution? Take it, Steve.
No, I think it's, once you get into the client or customer risk ranking, we've seen many, many different models, right? This is where you start to get into the data-intensive portion of this. So you may be looking at customer-specific information, industry that they're in, geography, products, transactions they naturally engage in. So it really is, multi-dimensional risk consideration when looking at that. And so when we've worked with that before, we have tiered risk scoring based upon those different attributes. Okay, and I think just about everybody would have that to different levels of sophistication or complexity. It's very, very tech-heavy type of work. The only thing I'd add just while on that is just recognize that for however you define that risk at that point in time, that could all be different 3 months from now. And I think that's where I've really seen some firms skid on the pavement here, where they feel that they've really identified their risk profile. They think they understand their clients, but they're large, complex organizations, and some of the attributes change. And there's a certain amount of awareness and process that has to be in place to really keep ahead of that. So I'd say
key.
managing, identifying the risk is really the beginning of this. And it's not all quantitative. It certainly is qualitative, but it's a process to go through. It takes some time.
Yeah, and it should be, I like what you said there, Steve, it should definitely be an evolution. The risk ranking in and of itself can change in time. We definitely have that, a dynamic risk rating process, and it does make you then all of a sudden take that second look based on whatever factor has changed. Take that second look at that institution, whether they've been a customer for 5 days or 50 years.
Right.
Yeah.
And the only thing I should add, just because I'm afraid I might be making it sound more complex than it need be, to me, when you're working through this, I'm not trying to, let me get a risk score for Steve Beatty, because candidly, in terms of onboarding, I'm fairly boring, right?
I wouldn't say boring, Steve.
Yeah. But, I fall into a core category, right? You don't want to spend an enormous amount of time, but I think you'd want to look at like whether you're going to have one bucket that's pure prohibited. I don't need to get all of those different scores. I just know I do not get involved in that business, because of its risk profile. I can mitigate the risk. It makes no sense to be in it. There's that middle bucket of what I call specialized. So you've got core, prohibited on the other ends, and specialized in the middle. And I think that's where those scores and the thinking and the debate and the scoring really comes in. What do you think?
Well, I agree with that, because I think I view the granular customer risk rating, which we all must do as part of our due diligence, critically important. That is almost evidence of adherence to your risk appetite, as opposed to the setting of your risk appetite. And as you go from the higher level, this is who I am, what I want to be, to more specific guidance to your people out prospecting new business, that's that middle area that is specific enough so the business knows of clusters and categories, but not so granular that you get lost in the number of people ranked high versus medium high, et cetera. And I think for me that is a critical distinction between this type of exercise and more granular of customer risk rating for KYC purposes. It is in that sense a lot more akin to what you see in a risk assessment, because you do at that point want to step back just a little bit to see what sort of buckets and striations you break down into. But it's a part of a spectrum in my view. But I think, Steve, your point is dead on. Say don't get too swept up in the granularity of individual ones, because it could be critically important if somebody exceeds a tolerance in any one case. But if you're looking to set it and provide proactive guidance to people, you don't want to get down that deep.
I'm just going to make one clarification, and that is, Steve, you mentioned, 3 months later your risks might change. One thing I would say is, I think you're talking more about as far as specific customers. But, obviously the one thing when you go into your risk ranking, your model per se, or your tool, whatever you want to call it, right? You've got to take the care into it to make sure that you're testing kind of against what you've set up as far as your appetite, as far as prohibited and restricted customers. You've got to take into the care of testing the outcomes and try testing the outcomes across all business lines and trying to keep some of those models as best you can synced up as far as the same approach with those business lines. So you don't have so many inconsistencies. It's really difficult, definitely difficult to accomplish. But it's something you've got to look at and test. So, because you don't want to go back 3 months later and have to change your risk ranking model. You may 2 years from now, but you don't want to do it 3 months after you've put it out in place. So I just wanted to draw that distinction.